Thank you so much, Christine, for taking the time. I think it's so great to have you in the podcast, especially in this educational podcast where we cover more the pre-IPO. What are the lessons? What are the key concepts? What's happening in the space? And having somebody like you you started as in the investment banking across the globe, right? You've been in Asia, New York, San Francisco, it seemed, and went to Forge, Destiny, and then now running your own concierge service for investors to invest and access pre-IPO companies. So it would be so great to have a bit overview on how that journey was. Like now it all makes so much sense, but I'm sure that when you were in the journey, you've been figuring things out, you've been fighting, you've been figuring like the way to the next step. So it would be great to hear a bit more about your background and what are you seeing now?
Great, thanks for having me, Mona. So yeah, in 2018, I left investment banking and I was looking for a startup that had a mission I could believe in. And I stumbled across what at the time was called Equidate, which then became Forge. And they had a mission to create almost a stock exchange for private companies. At the time, some of the most iconic companies in that class were Airbnb, Uber, Pinterest, Lyft, which have since moved on to the public markets. So I was an early employee at Forge, employee number 23, and really grew up in that organization, seeing some of the earlier stages of pre-IPO trading in some of the top unicorn companies, specifically US company focused. After a couple years there, I moved with Forge to Hong Kong to work on cross-border transactions, seeing a completely different set of institutions, transactions, issuers, and so on. So at this point, I made the decision to join Destiny, and I was the portfolio manager for the New York Stock Exchange listed DXYZ fund for just under 3 years, at which point I decided to scratch the entrepreneurial itch and start my own business as a specialty pre-IPO broker. So approximately 6 months ago, I started Healey Pre-IPO, where I work independently to provide a concierge access service to investors such as individuals and funds to get access to high growth pre-IPO companies.
That's amazing. And I'm sure the space has changed quite a lot, or has it, in the last years? What do you think?
I think it's changed a lot. Of course, the issuers that are relevant at a given point in time are constantly recycling based on which are the pre-IPO companies of the moment. So as I mentioned, when I first started, there was a lot of Airbnb, Pinterest, and so on. In the current market, there's a huge interest in AI, as well as in SpaceX and some other companies. So the company set is constantly shifting. These structures that are common are also constantly shifting because the structures are generally company dependent as well. So if a company has certain transfer restrictions, then a certain investment structure is going to be common. So the structures have been in flux quite a lot since I started as well. And then in terms of who's actually investing, I think it's broadened quite a lot. So more institutions have gotten comfortable over the years with investing in private deals, but equally awareness has grown among individuals and is still growing so that high net worth individuals can access some of these same deals as larger institutions as well.
Yeah, thanks for bringing that up. I feel like that was really the common point that we share, because for us, we take it as a granted. Like, we're in the space 24/7, literally. And it's something that we're so used to seeing, the access to XAI or OpenAI or SpaceX or like whatever top company in the world, right? But still, there's a lot of family offices across, Asia, Europe, Latin America, US, that they don't think that they have the access, or maybe sometimes it can be a bit like intimidating. You think like, oh, like I can actually like get shares in Stripe or large companies like that are about to list. So I feel like the purpose really for this podcast and this conversation that we have is to share a bit more like the basics of that space, to make sure that people understands that in the end of the day, like if you're a family office and you look to diversify your portfolio more towards the private, which is getting increasingly huge compared to the public markets, there are structures in place, like you're saying, Christine. So thanks for bringing that up. But basically, what are private companies? Maybe just quickly on that. So these are companies that are non-listed. So they are privately held and owned. You can't buy the shares in stock market, and hence these are less liquid or less tradable, as you know, so called. And because they need to, like, obviously, if you want to buy or sell these shares that we've been speaking about, you need to find somebody that is willing to share at that price or willing to buy at that price. So that makes the market more like less visible, I would say, and less liquid. But then at the same time, these companies, they don't have the same information kind of requirements as public companies would need to report quarterly their information. So what happens if you buy secondaries? There's going to be less information available about these companies. Like why investors should kind of invest regardless of that illiquidity or the information rights.
I think the reason why many institutions and other investors have waited on the sidelines for several years now has been to do with the nuances of the asset class. For example, you mentioned in a pre-IPO secondary, it's quite common not to have information rights or not to have company financials available, which is quite an adjustment for many investors or family offices that are used to public market investing and having a whole underwritten analysis around a company. So I think that was why there was some friction for some time. But you've also seen such incredible success stories in the private markets, SpaceX being one of them, and several others, where I think investors are weighing the potential returns or some of the returns historically for some of the standout companies versus the friction and the apprehension around difficulties and details in this asset class. So if you're dealing with an asset class that may have much higher returns, you might be willing to work in a different way than with a different type of investment. So I think now, after many years of sitting on the sidelines, institutions are saying, we don't want to miss out, and we're going to have to figure out a process around these private companies to not miss out on some of the real heavy hitters. So one of the ways you can do that in pre-IPO companies where you don't have a full financial data set is to look at secondary market data. So where you may not have the latest company pitch deck and financials, you may have almost as more of a technical analysis. You can look at secondary market closed trade data, secondary market bid and offer data, 409A valuation data, and other pieces to get a picture for how supply and demand are trending, and piece things together that way. So as the market develops and more people come to market as buyers, there's also more sophisticated data and resources available to build out these investors' theses and to help them get comfortable.
That's interesting that you say, because now obviously, like, I feel like the last probably 2-3 years, there's been a way more platforms to kind of figure out the pricing as well, where you can, trace back and see like the bids, sold and also the bought shares. So I think that's a big one as well. But do you feel like there are cases where those pricings are misleading, or do you feel like they are still pretty accurate, what you can get from different platforms?
I think because the deals, the prices, the terms, and the structures in this market are so circumstantial, there may be more data available and more platforms and services available than in the past, but you still need to understand how to interpret it and qualify what you're seeing. So it can take a bit more of a savvier eye at times to interpret the data in a way that's most useful and most accurate. For example, you see a certain closed deal. Well, what size was the deal? How many buyers were involved? Was it one buyer, one seller, closing $10 million deal? Or was it an SPV closing with a large seller where perhaps there were 30 different investors backing that SPV? And so, a data point that just says $10 million deal closed at $100 per share doesn't necessarily tell you the full picture. And if you understand the details and how it was priced and who was involved, it gives you a better landscape as to where more of a larger wholesale market might be pricing versus where smaller deals might be pricing and everything in between. So to your question, yeah, I think there's still a lot of interpretation. And while there's more resources and data sources than ever in the private markets, I also think that it's as fragmented as I've ever seen it. And it requires a bit more expertise in navigation. And that is where brokers and other experts come in to help sift through the noise and interpret the data.
Yeah, but that's an interesting point of almost that supply blocks or like the supply streams. Like if you are sitting in an SPV that is, let's say 5 million versus 50 million SPV, like it matters how you can sell that later on as well, right? But how much you would say that there is spread within the pricing, like compared to the sellers that are most willing to sell that share or sell that stake compared to the ones that they're like, I'm super fine sitting with the company. If someone wants to buy at a good price, I'm happy to sell at X. Like how much do you think there is actual spread within those pricings?
I would say there still exists quite a material spread often between where buyers are at and where sellers are at, or oftentimes where one seller may be at pricing wise compared to another seller. In part, that's because secondaries may come from different sources. For example, employee sellers of employee stock options or shares, and everyone's different. So someone may have a very personal liquidity need, whether it's medical bills, starting a new business, buying a house, diversification. Some more urgent than others. And so there's a human element or a psychological element where someone may really want cash for their shares this week or this month, and they may have a bit more flexibility on pricing than, for example, an institutional fund that is really trying to optimize for price and might be willing to wait longer to transact. So I think the markets are interesting because of the breadth of market participants who all have very different needs, goals, timelines, and psychology. And because of that, it creates opportunity if you can find the right deals at the right time. But again, understanding the idiosyncrasies and the profile of who you're working with to understand where to optimize.
Yeah, that makes sense. And I feel like with those most tradable names, there's probably less spread within the pricing, as there's so many transactions that kind of for the ones that, like you say, are optimizing for certain fees or certain pricing, there is going to be less wiggle room, I guess. But for the companies that we see more maybe in the growth mid-market side, the market is not as active. So it's probably less easier to kind of trace back the exact pricing. But anyways, you mentioned a word SPV that came up. Maybe we can just break down that real quick. So basically, there are a couple ways how to invest into these companies. So one way is going directly buying the shares in the company so that you're sitting in the cap table, you're one of the shareholders. And then another option is to buy shares in an SPV or so-called special purpose vehicle which is dedicated investment vehicle that is buying shares from the underlying company. And I guess the last one, which is the most indirect, and I'm curious to hear your take on this, is the second layer SPV, which would be an SPV sitting on an SPV that is in a cap table. So this is basically the ways how a family office or an individual can buy those shares. But can you share a bit, like, what's your take on that? Like, why would you buy an SPV? Is there some companies you kind of have to buy SPV? Is there some situations where you're happy to do second layer? Like, what's the difference of those for a family office?
Yeah, a great question. I think all things remaining equal, investors will always love to be on the cap table and own shares directly listed on the company's cap table. When you would choose an SPV or when you would choose a different structure or a multi-layer structure is really by necessity as well as by opportunity. So if we're talking about how individual investors can get involved, an individual investor, perhaps they're investing $100,000 or $250,000, they are simply, generally speaking, not going to get the access to the company's cap table because the company's own primary rounds and other fundraising events are generally only open to ultra large institutions, and they aren't really interested in having individuals on their cap table unless they're billionaires or they're investing $50 million a piece. So there's kind of a necessity element where an individual just isn't going to get access directly on the cap table, at least in a primary. Now, for some secondary deals where the company does allow free market trading on the secondary market, an individual may be able to purchase shares from an existing shareholder. And if the company allows it, they may be able to buy directly on the cap table. But that would be in a secondary from an existing shareholder versus a primary. And where the company allows it, that's usually a great option. When you're doing a secondary transaction through a direct transfer where the company allows it, that does add a process of company approval, including what we call a right of first refusal in most cases, or a ROFR, which essentially means you submit the trade to the company. They take time, usually 30 days, to review the transaction and approve the buyer and to permit the trade to proceed. There are some other restrictions that some companies may have, like a board approval, or some may have a co-sale for certain sellers. But usually you can expect at least a 30-day right of first refusal if you're doing a secondary that will end up in the investor being on the cap table of the company. Now, when you would choose to invest in an SPV rather than direct is really when that company doesn't permit direct transfers, or when you're seeing an opportunity from a venture capital fund that may have originally purchased the shares through a vehicle. And so perhaps that's where the shares already sit. So for whatever reason it's come about, typically an SPV deal is where investors are being pooled together so that the group may have much more buying power and be 5 million or 10 million or larger size. And so they can access some of those institutional size deals by investing together as a block.
Perfect. I am happy that you brought up this one super important thing, which I think it's one of the things or points that family offices or investors really have in their mind when it comes to investing in private companies is really the ticket size, right? Because people think that they need to put 10 million, 50 million in order to access these big companies, right? But you're saying that some SPVs, the minimum ticket you can access is 100K, which is a retail ticket. So I'm happy that you brought this up, but do you have like any comments about that you've seen maybe some like tendencies with family offices that they build up their portfolio of investing maybe less in certain companies, but they diversify, or anything you kind of wanted to add on the ticket side of things?
Yeah, absolutely. I mean, I think because this asset class is inherently more risky and less liquid than the public markets, diversification is a fantastic thing. And, many buyers may want to buy many different companies within this space rather than going all in on just SpaceX or just a few others. But if ticket sizes are extremely high, of course, it's harder to diversify, particularly as an individual. So it's critical and it's helpful to have lower investment sizes so that if you were investing $1 million, let's say, you can spread that out among a few different companies rather than being required to go all in just to hit a minimum ticket size. So if you're looking to have what we call bite-sized stakes in certain companies, SPVs are your best friend, but you have to differentiate between quality SPVs, quality terms, and do a more fulsome diligence process, because at the end of the day, you're going into a vehicle rather than directly on the cap table. So it's really important to understand the terms and conditions and the costs and the other elements of the SPV you're in to make sure it's a good one for your needs.
Yeah, and how much do you think you need to understand also the manager, or would you say it's more the share class, the fees, the pricing that you would take into consideration?
Yeah, so I think you have the intuitive elements being the terms of the deal. So what price am I getting? The shares is the underlying more basic transactional elements. And then secondarily, you also have the mechanics of the vehicle itself. So is it audited? Is there carry? Is there management fees layered on top? Are there admin costs? How will a company exit be handled? So if that private company does have an IPO, will I receive for sure my shares, or is there a chance that they could be liquidated into cash and I would receive cash? And most investors want to specify and make sure that they would receive shares at the end of the day post IPO, and that there's no chance they would be liquidated into cash. So that's an important thing that I try and catch in the documents and make sure investors are asking when they go into an SPV. In terms of the manager, I would say that's the third thing. Who is my manager? Sometimes these companies aren't going to be planning an IPO for many years, could be 5 years, 10 years, longer, indefinitely. So it's important to know who you're getting into business with and making sure you have a good rapport with your GP, the SPV manager, and making sure they're credible and that's going to be a good working relationship once you become their LP and you're in this for the long haul with them. So sometimes my clients will also ask, okay, is the GP a registered investment advisor, or check some other, credentials, or at a minimum, most will do one or more video calls to get a sense for how that person operates that's going to be their GP.
Yeah, totally. And I feel like a lot of the times when we share deals, at some point, I would say probably after fees and pricing and the size comes the description of the GP, right? I feel like a lot of the times that kind of comes as the third, fourth point, probably, where we say like, okay, the seller is XYZ region, like this size of AUM, probably, or very robust. We have previous experience of working with them. They're very, great working with, institutionalized. So I feel like that's definitely something that a lot of the times, especially when we talk about different blocks, it comes up. Like it definitely does come up.
Yeah, I think that's a fantastic point. There are things to do with the manager or to do with the vehicle that come up so constantly when we're discussing a transaction or when I'm presenting a transaction to a client, and we like to anticipate what we know they're going to ask, or if there's a particular feature of an SPV or a manager which is differentiated or very valuable, I'll often present that up front. Like, it's an audited vehicle is usually seen as a plus. A lot of US investors also are more comfortable investing in US vehicles, or equally, international investors may have a preference for non-US vehicles, sometimes for tax or other reasons. So that's another part of being a broker, I think, is knowing your client. Do they prefer US or non-US, and for what reasons? Do they have a requirement that the vehicle be audited or that the manager be a registered investment advisor? and certain other details, is there a custodian, some of these things. So yeah, absolutely, to your point, these things come up quite often, and it's one of the main things we'll highlight, especially when you get into the SPVs and more convoluted structures.
Yeah, and I feel like it definitely plays in favor for those investors at the selling points. So like you say, it's really good to anticipate that as well in the buying process, like really make sure that one day you need to sell that, and making that as easy and with optimized pricing. It's, it has to do with who is holding the SPV. But I think we were talking about also kind of the share classes and different terms. Maybe we can just break that really quickly for our listeners. So basically, there are two different share classes. So one is common shares. They come with voting rights. So that really allows the shareholders to influence the decision that the company can be electing board members. There's also preferred shares. So they act more like a hybrid between stocks and bonds. And they lack voting rights, but at the same time, they have the priority in dividends and liquidation payouts. So they make them slightly more safer choice for investors that are seeking stability, right? So what do you think about this? So a lot of the times when we look at a company or a block, the question comes, okay, what is the share class? It can be a mix or it can be common or preferred. So what do you think, especially maybe in the secondaries, how much this influence the actual final decision of an investor, whether they should prefer one or the other?
Yeah, great question. I think there are two main benefits that come to mind for one share class versus the other. The first is that some may, as you say, be structured in a way that's less risky or have certain downside protections. Like some classes of preferred shares may have a certain liquidation preference price, so that in a downside scenario, you have a bit more transparency or a bit more certainty or a bit more protections compared to just a common shareholder. So that can be quite attractive. But as I say, that's really for a downside scenario. So when we're dealing with these pre-IPO companies, where many of them do expect an IPO at some point in the next 1 to 3 years, these are generally companies that are quite mature, large, in some cases hundreds of millions or more of revenue. And many of my investors are more focused on an upside scenario versus downside. They don't really anticipate that some of these giant decacorn companies are going to be liquidated or go bankrupt anytime soon. It's considered a relatively unlikely scenario. And so for this stage of company in particular, that could be a few years out from IPO only, in some cases, most of my investors don't care that much whether they're getting seed shares, whether they're getting a certain stage preferred, whether they're getting the latest round preferred shares, whether they're getting common shares. It doesn't matter quite so much, because once a company does go public and the shares are delivered out, for the most part, there's no difference between the shares based on how they were classified pre-IPO. So I think that's one important thing to note. There may not be a difference, and when you're trying to get a company, particularly that's hard to find or hard to access, many investors are quite happy to get common shares, and not picky about waiting for a certain preferred share opportunity, because they have this thesis that the IPO is very soon. And as long as they have the same economic exposure, they won't have to rely on some of those downside protections. But I will say, just for the sake of balance, it is a risky asset class. And we've also seen some spectacular failures of these companies that seemed very mature and very, very certain and were not. So FTX, for example, was a company that several years ago was traded fairly actively on the secondary market, and its value completely collapsed. Fortunately, I never brokered a transaction in that company, but I certainly saw it offered and discussed it with some clients. So It's not a bulletproof asset class. There are still risks, and so all things remaining equal, you would rather have preferred shares than not. But in many cases, it won't make a difference to your actual economic results post IPO. Now, the second main benefit of one class versus another might have to do with resale on the secondary market or the investing process itself. So not always, but oftentimes preferred shares have much looser transfer restrictions than common shares. And so, as I mentioned, it's quite common to have a 30-day right of first refusal process with the company if you want to sell your shares to an open market buyer. Many times preferred shares in even that same company will not have a 30-day right of first refusal. So sometimes buying into companies and then selling your stake in those companies can be much more seamless and fast if you have some classes versus another. So that can be huge, both when you're looking to buy, but also with the vision of what would the process look like in future if I ever wanted to resell this position I'm buying into. So in a class that is very illiquid in general, some of the features of one type of stock versus another can add somewhat more liquidity in terms of transactability on the secondary market.
Interesting. And have you seen ways of going around that? Like, for example, if it's a cap table transaction and the company is blocking those transactions and you're trying to set up an SPV instead of going direct. So have you seen like ways of going around that after the, when it's hard to get the transaction moving, or is there a way around?
Yeah, again, all things remaining equal, you would much prefer for the company to be blessing the transaction you're doing and having them sign off. It just gives it that extra air of reliability, reputability, you're in the company's ledger. So that's what you'd like. However, there are many companies that historically have been extremely strict towards transfers. Many are even more strict towards their employee shareholders that are trying to sell common. And it can be a huge tension as companies stay longer and longer as private companies and delay their IPO. So imagine a situation where you were very early at Airbnb, for example, and you may be 10, 12 years into your tenure at the company. You could potentially have $5-10 million of wealth on paper through your Airbnb common shares. But if you weren't able to transact because your shares were restricted, then it could be very difficult just to have the cash flow to start a new business, to diversify, to send your kids to university, or cover other things that may come up. So it's an extremely common situation when you start to have these pre-IPO companies take 10, 12, sometimes 15 or longer years to go public, that the shareholders really need liquidity. And I think different structures have popped up in response to that and structuring around that. I would say in some of the strictest companies, there have definitely been structures that have become more prevalent in order to get exposure on the investor side or on the seller side to get liquidity in even the toughest situations. So that's a case where you could look at if you're investing and you're trying to invest into one of the more difficult companies, that's where SPVs may come into play, where you can invest in a venture capital funds vehicle that might already hold the shares, so they don't need to be moved around, which can sometimes help if moving around shares is difficult. And there are other structures as well for stock option financing. If some shareholders are having difficulty in affording to even exercise their options with certain companies. And other means. So I do think that the tension is becoming more and more powerful at some of these larger companies that have been private in some cases for 10 plus years. And the market is evolving and more service providers are coming to market with solutions for even the trickiest circumstances.
Yeah, I'm super happy you bring that up, because I feel like that has changed a lot in the last years, right? Like, now the fact that the IPOs are pretty much frozen. Like it's very hard to go public within the last 3 years that we've seen in the IPO market. So it is way more accepted to trade secondaries, and even like whether it's Series A or Series B company founder or an early investor wants to sell, like I think it's no longer that taboo of like, oh wow, like you don't believe in the company anymore, like you are selling. Like it's way more understood, and a lot of the times those secondaries are done for practical reasons. Like you say, like you need to buy a house or you need to finance certain practical things in your life that you wouldn't be able to do without cashing out part of the shares. So I think that's very positive to see that change in the thinking and attitude towards being more accessible for secondaries. And a lot of the times, even now in Series A or Series B rounds, we see it's a mix of primaries and secondaries. So say it's around 8 of that is primary and 2 million is secondary, and it's almost something that it's a norm now. It's like, okay, how much is the secondary, because it's way more accepted than it was before. So I'm happy that you bring that up.
Yeah, absolutely. I think that from my experience working with many different buyers and many different sellers, it's very common for an employee shareholder that's looking to sell to still be very bullish about the company that they worked for in the past or still work for, and to believe that they're going to be this wildly successful IPO story eventually, but they simply need liquidity or they want to diversify. So even if you, let's say you work for Anduril or you work for one of these, iconic pre-IPO companies, you still don't necessarily want 90% of your wealth to be tied up in one company just on first principles of personal finance or of investing. So it's just extremely common that these shareholders, particularly common shareholders, really do still believe they're just trying to be sensible about how they divvy up their wealth between different sources. So that's extremely common. And I think maybe there's a misconception at times that someone is selling because they know something I don't know, or they think something bad's going to happen to the company, or they don't believe in the company. And oftentimes it's nothing to do with that. It's just a personal financial use case for the funds. At the institutional level, equally, oftentimes institutions will have these amazing gains on paper from a private investment that went from Series A to Series B and then became this huge unicorn, but they need to show real returns to their investors. They may be about to raise an additional fund and need to show real results. And so the tension is there also from institutionals to actually get gains realized in some of these positions. So secondaries are a way also for institutions to get actual cash for some of their best performing positions, so that they can then go fundraise and have those be bona fide results that they can then leverage for future projects.
Yeah, totally. Like for institutions, it's pure portfolio engineering, right? Like it's moving things from, one pocket to another to make sure that, like you say, you get the DPI and you can show actual results. But what about the fees and cost of investing? So with these, whether it's an SPV or it's a direct transfer to the cap table, there's always fees involved. So just to kind of cover those, like the main fees that you might hear from is, number one is the access fee, which is pretty common to see, or so-called like brokerage fee, however you want to call that. Management fee is something that we every once in a while see. And then there's the performance fee, so carry at the end. So a lot of the times it's like 2 and 10 we see, or 1 and 20. So what do you think about these fees? How much obviously it matters, but how much it matters in terms of like, okay, whether you pay upfront and pay more upfront and have less carry, or have slightly more carry and have certain access fee? Like how do you see those dynamics, and how those maybe differs from company to company? Can you get more fees from certain companies than the others?
Yeah, well, firstly, to touch quickly on what happens fee-wise for a direct transfer, if you've utilized a broker to find you your seller or your buyer, typically the largest fee that you'll deal with is the broker fee, which often starts at a default 5% broker fee on the transaction size. And then occasionally that'll fluctuate up or down, usually down, based on size and other details of the deal. So that's usually the biggest, most notable expense for direct transfers. There are some cases where the company may also require extra things, which can cost a little bit. For example, some companies require a third-party legal opinion to be pursued, which can cost anywhere from $1,000 to a few $1,000s from how I've seen it. Not every company requires that, but it's something to be aware of, that each company has their own process. Many investors or sellers also will have their independent tax advisors, wealth advisors, or whoever else they need in order to get comfortable around a transaction. So that's something to keep in mind as well if you're buying or selling, and making sure you have the advocates necessary based on your personal situation. And those are really the main costs that come to mind for direct transfers. Now for SPVs, you've highlighted some of the main ones. There's, again, the broker fee that you're going to pay for the access. You also have the vehicle fees, whether that's carried interest, whether that's an ongoing management fee. Sometimes you'll see the management fee be charged all up front rather than continuously as an annual charge. It depends on the situation. That's one thing that sometimes you can also negotiate if you prefer it one way or the other. So in my experience, the vast majority of my clients would prefer what we call a 0-0 vehicle, where there's no management fee and there's no carry. And the vast majority of my clients would disproportionately prefer that to a vehicle that has fees and carry on it. And often they're willing to pay sometimes quite a bit more just to get it fee-free in that sense, compared to a different vehicle with more fees attached. So in my personal opinion, I think you have to balance the two and say, if I'm paying the fees and the carry, am I getting a price that's lower enough to where it might compensate and still be a better deal? Or, all things remaining equal, is it worth paying slightly more for the vehicle that has less continuing fees? So it's a personal choice, and you have to basically look at the full picture, because sometimes a deal that has more fees and carry on it could be a better result if it's coming at a much lower share price or other situational factors, whereas in some cases that could be the more expensive option. So I think it's important to look at the details and to not have a preconceived notion of which deal might be better, and to actually interpret the details and run some scenarios to figure out which one will be cheaper and more beneficial in the long run.
Yeah, totally. I'm super happy you bring that up, because it's really looking at the price and the fees together in the same page, right? Because like you say, sometimes the fees or the price can be way lower or way higher. But when you compare those to the fees, you start to see like, okay, maybe some of the fees are baked into the price, and hence it's lower or higher. So it's definitely something that, even those are two separate lines, it's really important to have them, side to side and compare them to the other options that you have, right? Because it's something that you can make a big difference there. But why some people prefer to pay more upfront and take 0-0?
The vast majority of my clients would prefer a 0-0 vehicle, even if it might be slightly more expensive than the other option, because they are very bullish about the prospects of these companies, and they are more upside focused investors. And so they want to be sure that they are capturing the entirety of the upside from the point of investment. And they are quite resistant to any kind of fee share or profit share in the form of carried interest on the future success of the company. So I would say that's the main reason. There is also a practical element where if an investor might be considering if they would sell several years down the road, all things remaining equal, it is slightly easier to resell an SPV position that is 0-0 than to sell a position that has fees and carry attached. So that's another, I think, benefit if you're going into a 0-0 vehicle, is that it's slightly more resaleable down the road should you need to sell.
Interesting. But what about then the manager? Does it say something about the manager that if you as a manager, you host your SPV, you don't have any carry, so you're not incentivized for the performance of the company, versus you have carry and you are aligned with the company? Does that communicate that? Am I reading it wrong, or how would you see that?
Yeah, I mean, probably a controversial topic. I think that's how many managers justify why they deserve this profit share or this carried interest. It's just going to be situational and depending on the party you're dealing with. You know, some managers may drop those fees and just try and do a lot more volume, and that's how they make it worth it for them. You know, understanding that demand might be even larger if they do it in a way that's 0-0. So it's just managers have different styles and different fixed rules, and as do buyers and sellers. So it's just another type of thing that we do navigate. You also find that sometimes the fees on the vehicle can be negotiable based on your size, based on how quickly you can close, or other particulars of your situation. So there are some cases where a manager may have a certain deal, call it 220 as default. But if you're investing a particular amount, or if you can get me those funds by next Wednesday or whatever it might be, they might have a bit more flexibility. But equally, you have some managers that are extremely rigid about the default fees and will make almost no exceptions ever. So that's another thing we navigate as brokers, and understanding which circumstances we can advocate for an improvement and then which circumstances are not going to be possible.
Yeah. That makes sense. One last question I wanted to ask, the information rights. So if you are an investor, say you're a family office investing into an SPV of XYZ company, what information rights you'll have to that, and how demanding you would kind of want to be around that topic? Is there some minimum requirements of information that you kind of want to have, also thinking about the future sale, or what's the game with the information?
In terms of information on the actual issuer, whether it's SpaceX or Stripe or some other company, many of these pre-IPO companies are extremely strict around their data, especially financial data, and it's simply not going to be possible to get a data room or any detailed updated financial data set. So that's one of the biggest adjustments from public market investing to private market investing, is getting comfortable having imperfect data transparency around the company's progress, financials, milestones, etc. So that can be very, very difficult. I do think that with the data sources available today in the private market, you can find alternative ways to view an opinion on the future of a company, whether that's private market transaction pricing momentum, whether that's primary transaction momentum, or other means. So that helps. But in general, investors that are coming into these deals, particularly if they're more retail or individual size, perhaps it's 100K to 500K, the baseline expectation should be that you're not going to get detailed, updated financial data. And that's the unfortunate reality of the situation. There are exceptional cases where it may be available. For example, if you're investing in an SPV where the manager does have information rights with the company, or they do have a recent data room, And sometimes under NDA, you can get a sense for that or have a diligence call with the manager to ask your questions around the underlying company. But it's relatively rare, and I see it more as a bonus when it is available versus a requirement. Because if you only invested in companies that had very transparent data, you would be missing out on the vast majority of private market companies. For example, as an example, Klarna is a company that historically has actually been very open in reporting a lot of its financials, which has been fantastic and quite a cool way of doing things. But equally, you have companies like SpaceX, Impossible Foods, and just so many others that are notoriously tight in terms of their financial data and extremely, extremely private. So if you simply didn't invest in companies that were tight with their data, you wouldn't be able to invest in names like SpaceX or some of these top companies. So it's a reality that I think some market participants have just gotten used to and have tried to solve around.
Totally. And I feel like a lot of maybe earlier stage investors that are used to having access to like founders and all the decks and whatever information, KPIs, cohorts, everything that comes out from the company, like they already have like that access. But I feel like maybe for those investors that are used to doing more startups, there is some, like learning curve to understand that, especially with secondaries, it is not the game, right? And like you say, it is for a reason. People are under NDA that they respect, and they just can't share that information. But at the same time, I feel and I find those cases super interesting where we have a fund manager or a manager of an SPV that is a previous investor or very close to the founders, and they are able to supply good quality information frequently to the investors and share a VDR. And I think that is so amazing. Like when I see those cases and like fund level DD, VDRs, close connection with founders, having that constant report is just something that gives me so much hope, because it's that transparency that we all like to see. But at the same time, like living with the reality of these are private companies and they cannot disclose everything as a public company. So and there is the alpha, like you say.
Absolutely. And I think, of course, get as much information as is available, ask the questions. Most likely they will say no, there isn't, but it doesn't hurt to ask questions and just get as much information on what you're investing in as possible. At a minimum, I would say, even if you can't get any data on the company, you should have a pretty good sense of the information about the vehicle that you're actually investing in. Yeah. So you may not get SpaceX financials, but you should certainly know the details around the SPV that you're investing in. You should be able to ask questions around how an exit will be handled. You should be able to fully understand the picture in terms of fees that will be charged to you. Will I have to pay a fee when the company exits and shares are delivered to me, for example, and all these other nuances. So I think if you can't get a full picture of the company that you're the underlying company you're investing in, you should at least have a full picture as much as possible of the manager and the vehicle. So I would always really recommend going through your transaction documents, like your subscription document, private placement memorandum, etc., in a lot of detail, and really understanding those terms and conditions, because not every SPV does it in the same way, and you are generally in it for the long haul. So as much information as possible on the SPV and the manager is always a good thing.
Amazing. Amen. That's a good way to summarize that. And it's very true. You are buying the shares of that SPV, so it does matter. But anyways, we've gone through a lot of different topics, I think more than we expected. So going all the way from how to get into companies, what different shares there are available, fee, pricing, covered a lot of grounds. But I just wanted to last but not least, ask your 2 cents. Long time, you've seen a ton of transactions, you've seen a lot of investors looking for different things. So what would be your 2 cents?
I think it's been an exciting industry for some time now, a super exciting asset class. It keeps me learning new things and evolving and working with all types of different folks that are trying to get involved in one way or another. So it's an extremely dynamic asset class. And I am just so excited that more and more investors and participants are becoming aware of it and able to participate. So vehicles like SPVs and other ways of pooling buying power have been really effective in giving opportunities to everyday investors to hold an investment stake in some of the most interesting companies to them that really inspire them. And so, of course, there's a financial element. They're aiming for growth that is greater than many other asset classes. But there's also something just so powerful about being able to invest in the future and being able to have a stake in the companies that you personally believe will change the world as we know it. So it's been a fantastic industry to get to know, very, very specialized. And I just love being able to help investors find that company that they love and be able to get into it as an investor, because the market is so difficult otherwise. And satisfying things is where my clients have been following a specific company, whether it's SpaceX or some other company, and to help them navigate the market and to make sense of what's available to them and to get the result they want is extremely satisfying. And they're very energized and inspired by being able to access the companies they love the most.
Totally. Like, I couldn't agree more. It's such an interesting space. And I feel like every day we wake up to like new reality and we see so interesting companies. So it's a pleasure to be around. And also it's amazing to have great people and professionals like you operating this space, being so helpful for people around. So that's always amazing. So I really, really, really appreciate you taking the time, Christine. Thank you so much for sharing your wisdom. I hope we can do more of this, and yeah, we'll keep going.
Absolutely. Thanks, Mona. And there's more information on my website at healeypreipo.com. And you can always reach out to me directly as well to learn more. But this has been fantastic. Thank you, Mona.
Thank you.